And I think we're looking at March next year, ultimately. But I wouldn't be surprised if it happens before then. When that happens, then basically, I know this sounds a bit panicky. When that happens, basically, you should already be completely out of credit, because the collapse, I think, will be really quite rapid from that point. There is another problem there, and that is you don't own anything. When you might sort of have an electronic record that you hold shares in, say, Newmont Mines or something. You don't own it. Basically, what happens is that the management of Newmont Mines has an obligation to deliver to its shareholder an income stream, if you like, in the form of dividends and accumulation within the balance sheet. But who's the shareholder? TSXV or Euroclear. They're the shareholder, and they've got a knock-on obligation to you. So when the whole system falls apart, and markets need to have collateral in order to continue to survive, guess what? They'll take what you think are your shares, because they're not your shares. They'll all be pledged. So this is why I say just get the hell out of credit. You don't want to have credit at all.
You're watching CapitalCosm. It is November 5th, 2025, and my guest today is Alasdair Macleod, big fan favorite. Glad to have you back, Alasdair. How you been?
Nice to be back on this day in England. It's Guy Fawkes Day, and they try to blow up Parliament, and of course we celebrate it with fireworks.
Do you have your Guy Fawkes mask by any chance?
No, we don't have we don't sort of have masks. We just go out and enjoy the fireworks. That's all.
All right. Well, before you go out and enjoy the fireworks, we have to talk about the fireworks ongoing in the financial world. So let's go ahead and kick it off. Let's get into the nitty gritty here. DXY breaking 100. Go ahead. What's your overall take here in terms of what's going on?
Well, I mean, looking at the DXY breaking 100, I mean, it's a race to the bottom. Mm-hmm. I mean, basically, what of the major currencies, constituents of the DXY, would you buy or sell? It's immaterial. Really, what's happening is that the whole of the fiat currency system is coming to an end. And we're seeing evidence of this. Every fiat currency system comes to an end because of the accumulation of debt. And that's basically what we have at the moment, Danny. It's got to the point where it's not sustainable. If you look at what the US Treasury is doing, it's funding itself out of T-bills. I mean, it really is. The problem is there's no market on the long end of the yield curve. So they can't actually go out and replace maturing long-dated stock with more long-dated stock. In other words, ensuring that the annual rollover, if you like, of debt is contained. No, they're replacing long-dated with T-bills. I mean, that's where the market is. But what it does mean is, in effect, the US Treasury is printing money. I know it's using Fed dollars for it, but it's printing money because T-bills are near cash. So if the other side of the balance sheet is near cash, then you can see what's happening. It's leading to a certain amount of liquidity problems, because if the government, if the Treasury doesn't spend this money, and at the moment, the major parts of the government are suspended, then it accumulates in the general account. So it goes out of circulation. So it doesn't go back into bank balance sheets, if you like. Mm-hmm. So on that basis, you can see that, this is tightening the system. On top of that, we had QT, which was also tightening the system. And this is why the Fed has stopped doing QT and will reintroduce from this month, next month, whenever, quantitative easing. But that, again, is printing money. So, we're on a printing credit roundabout now. How else can we print it? Well, let's find another way of doing it. That's where they are. And this is roughly where Germany was, I think, in the very early 20s, 21, early 22. And we know what then happened. And we can see how it's going to happen here too, because when the credit bubble bursts, and the credit bubble will burst, this is the biggest credit bubble in history. And on top of that, it's looking so much like 1929 with Trump's tariffs on top, replicating Smoot-Hawley and all the rest of it. When it bursts, what it's going to mean is that the Fed and the Treasury will stand by to rescue the entire banking system and also all the major zombie corporations in the US economy. They have to do it because of the unemployment mandate, if you like. And of course, the Fed is also seeing in its beige book signs that the economy is falling over, toppling, if you like, stagnating, however you like to put it, turning down. So this is a time of maximum risk. Now, at the moment, I don't think that the stock market really realizes this, but there will come a point when it does. But for now, I think with extra QE coming in, if you like, the tightness in credit markets being alleviated, it could well feed into yet higher equities in the very short term, because what this credit has been doing is it's been puffing up equity markets. It's been angled at financial markets. Just look at the level of margin debt. I mean, the level of margin debt is over 1.1 trillion, having risen over the last 10 years from about 300 billion. And that is financing stock positions. We can guess roughly 3 times that. So when this bubble pops, the banks will be foreclosing as quickly as they can, which of course will drive the market down even more rapidly. And the interesting thing is watching Bitcoin, because Bitcoin basically is a tech stock with no assets, no earnings, but just the vibes, if you like. And you can see that it correlates so closely with the Magnificent Seven. Magnificent Seven go up, it goes up. Magnificent Seven goes down, it goes down. So what's it doing now? I mean, Bitcoin basically is threatening to break out on the downside. It's dipped below its 250-day moving average, and I suspect that if it breaks that $100 level, the $100,000 level, you will see an avalanche of selling. There are an awful lot of people long of Bitcoin who are just in there for profits. I mean, we get from the sailors of this world this sort of wonderful stuff about how it's going to go to the moon and so on and so forth. But, people are in it not because they think it's the new gold. I mean, that's for the fairies. They're in it basically because they want to make money, and they think it's an easy way of making money. You get this at the top of every credit bubble. And what the whole of the crypto market is telling us is just that. We are at the top of the bubble.
Yeah.
We might have another few months.
You also see yeah. I was just going to point out, you mentioned that it was below the 250-day moving average. This is the 200-day moving average here in red. And what you also see is this death cross between the 20-day moving average here in yellow. I don't know if you can see it. The 20-day moving average here in yellow coming down below the 200-day. So, not a good sign for Bitcoin and the overall crypto market.
Yeah. And there's an awful lot of leverage in it too. And that, incidentally, is not in the FINRA statistics. I don't know how much leverage there is, but this is a global problem. Things are going to turn sour. Now, it's always impossible to pick the exact top in a credit bubble, and you can be wrong for 10, 15, 20% easily, even though you've analyzed it correctly. So I think I'm not prepared to say that we are actually at the top and all the rest of it, but I'm seeing a few things breaking down. And we know we've got the liquidity crunch, and we know that what the Fed is in effect doing is moving from targeting inflation to supporting the economy and ensuring that it's got enough liquidity. That is bound to undermine the purchasing power of the dollar. So, it's 100, but also at the same time, I mean, this is the king rat of currencies. Other currencies are in exactly the same boat. It's just a question of who goes down fastest. And at the moment, it's not quite the dollar. The dollar might win that race to the bottom shortly afterwards. I don't know. Mm-hmm. Do I care? No, I don't care. But the thing that's interesting is that these, with the system under strain, I guess this is why people like Jamie Dimon are saying gold's going higher, and why, Morgan Stanley sort of turn around and say you should, put 20% of your portfolio into gold. Now that's an extreme statement, a very extreme statement. But I think that the really senior bankers see these dangers. They must be concerned about it, and I think that they would have told the Fed, look, you can't go on tightening like this. We're losing deposits which are going into the general account, and we're not seeing it come out the other side. We are under strain. You carry on this way, you're going to see the same sort of thing we had in September 2019. You may remember when the repo rate suddenly shot up to about 9%. And the Fed had to come in and sort it out. But we're not far from that sort of thing happening. I mean, it is tight, very, very tight. But where does this take us? Well, the thing that's absolutely clear is that if we can look through the top of the credit bubble, when it starts going down, Danny, you will see inevitably the duty, if you like, of the Fed and the US government basically is to keep the show on the road. And how do they do it? They would just accelerate the printing presses. What did they do in Germany in 1922? Accelerated the printing presses. We have exactly the same situation. And on top of that, we can superimpose our lessons from 1929 to 1932. The difference is that in those days, businesses went bust because the dollar was on a gold standard. And the only way in which credit got wiped out was by debtors going bankrupt. And the debtors included something like 10,000 banks. They went bust and didn't honor their deposits. Today, of course, you don't have that. So where is the strain? What happens? How do you reduce the amount of outstanding credit? Well, you don't reduce the amount of outstanding credit, but what you do is you reduce its value. Its value contracts, collapses even. And that's the way in which this is going to work. And the value of credit collapsing starts with the currencies. Currencies will go down, and unless the political class actually wake up to this, and unless their advisors get off all this macroeconomic rubbish and actually begin to apply proper classical economic lessons and inform the politicians of that reality, then there is no way that the fall in the purchasing power of these currencies is going to stop. That's what's required. We've got to go back onto a gold standard, in effect. Do you see that? No, I don't see that. And I certainly don't think that 8,130 tons allegedly, in the coffers of the US Treasury are there. I don't think they're there. I think there's a big shortfall. So you've got a credibility problem, which is being well aired, and it's well aired even by people like Scott Bessent. Guess what? As soon as he becomes Treasury Secretary and he gets his feet under the desk in the Treasury Department, what happens? He is told, don't say anything about gold. Stumm. Don't talk about it. Why? Well, I can see two reasons why. Firstly, they are in denial about gold because they have been promoting the dollar as gold's substitute, if you like. It's a dollar standard around the world. And the second thing is a lot of that gold, I think, went out. It was leased and never came back. You open Fort Knox, I think someone rather cleverly said, you find a whole bunch of IOUs sitting there. We don't know whether this is really true because, of course, we can only surmise. But intellectually and practically, I think it's going to be extremely difficult for the mighty dollar to if you like, get away from its total collapse. So that's what we face. I mean, this is a very serious time. We are in a sort of, if you like, in an intermediate stage where, the Fed is trying to put some liquidity back into the system because it sees the danger. It's been told the danger by its intelligence in the commercial banking network. That will give us a little bit of relief. It might even puff equities even higher. I don't know. But the only way you can get out of this, basically, is get the hell out of credit. It's really dangerous now. Get out of credit, which means getting into real money, which is metallic money with no counterparty, and it is final settlement for all credit, and that is gold. I think that's where we are.
Interesting. How? What inning do you anticipate us being in? Because you compared us to Weimar Germany, not at the very height of Weimar, but kind of pre-hyperinflation. How much time do we have left? What's the roadmap to the currency completely debasing or debasing by significant chunk? Kind of provide a little update or detail on that, if you will.
Yeah, well, it's impossible to say how long the final collapse of the dollar will happen. And you never know. I may be wrong. You could find that the authorities turn around and actually do something sensible, like secure the value of the dollar somehow. I mean, there may be some sort of fiddle they can do and all the rest of it. I mean, people have been talking about a reset for ages. It's not a reset. It's just to try and secure the value of the dollar. The only way that can be done ultimately is basically by going on to a gold standard. This slide, I think, could happen quite quickly. I mean, once the credit bubble bursts, I've got people who sort of seem to have been very successful in terms of reading cycles and things like that. And I think we're looking at March next year, ultimately. But I wouldn't be surprised if it happens before then. When that happens, then basically, I know this sounds a bit panicky. When that happens, basically, you should already be completely out of credit, because the collapse, I think, will be really quite rapid from that point. And they will obviously try and do what they can to stop it and all the rest of it, but it's just going to undermine the purchasing power of the dollar. So in terms of time, I don't think we're far away from the end of the fiat currency system. And the point about being close to the end of the fiat currency system is that we're close to it, fiat currencies not being there. Now, either they're replaced by something else like a new gold-backed currency or whatever, or they tie it to gold. And incidentally, have to take the economic actions to ensure that it sticks. We're nowhere near that. Nowhere near that. I don't know. I just sort of feel that we are actually moving more rapidly than we think towards the end game of fiat currencies. Mm-hmm. It could be a year, could be 2 years, could be 3 years. I don't know. But just watch. I think the first indication you will get is when the credit bubble pops. You'll then know that the end of the fiat currency system is not going to be terribly far behind.
Does that imply that our money in the bank is not safe? And if that is the case, would that also extend out to brokerage accounts and things like that?
I think your deposits in the bank are probably very safe. The problem is they won't even buy a cup of tea or coffee if you're in America.
Right.
That's the problem.
You brought up the repo buying recently from the Fed. This happened on October 31st. They bought about $29.4 billion in repurchase agreements, overnight repurchase agreements on the 31st. Now, this is a spike over the last year or so. You look back 5-10 years. Last time it happened was back in 2020 at these levels. Now, granted, 29.4 billion in today's terms may not be as profound of a number as it was, many moons ago. Is this a big deal, or is this just a blip on the radar? Should we be concerned about these repo purchases in the last few days or so?
Well, at the moment, it is a blip on the radar, but I think it's symptomatic, perhaps, of the background position. which is really what we're talking about. So I think you're going to see more of these problems. You may not. I don't know whether. I saw one estimate that the Fed's got to put about 150 billion into financial markets. Which will do by QE. It's got to do that pretty quickly. If it does it pretty quickly, then you're not going to see too many of these problems in the short term. And hey ho, the markets will continue to rise. Wonderful. But this is a very, very febrile time, Danny. It's very dangerous. Do you want to sort of ride this roller coaster until it sort of runs into the buffers at the end, or would you rather not play? I mean, that's the decision. That is a very difficult decision I think investors have. To my mind, it's actually quite simple. Just get the hell out of credit. If someone makes an equity, the last 10, 15% in equities, then good luck to them. You never get out at the top. You never, ever get out of the top.
Did we see a local top in gold and silver a couple of weeks ago?
Well, I mean, obviously it had run extremely well, and you could argue that there were profits to be taken and all the rest of it. The thing that's fascinating, though, is that while traders would have done that perhaps in futures and perhaps also in Shanghai, you still had a backwardation between London and COMEX. And if you look at the volumes in the silver contract on COMEX, I mean, it's just gone to a crawl. They're not dealing, basically. So nothing has been resolved. You've still got the problems there.
And you know what? There's also a backwardation. You still have the backwardation in the silver market. Spot silver's trading at 48.10. Futures market is 47.98. Okay, guys, quick pause because this one could quietly turn into one of the biggest uranium stories of the decade. It's called Homeland Uranium, ticker symbol HLUCF on the US OTC and HLU on the Canadian TSXV. And they just grabbed what might be the deal of a lifetime. A massive 35 million pound uranium deposit in Colorado that was discovered back in 1979 and then completely forgotten about when the nuclear industry collapsed. Now, Homeland picked it up for 15 cents a pound. Today, the same uranium trades for almost $80. And here's where it gets wild. Uranium prices are already up 141% in the last 4 years, with global demand expected to jump another 28% by 2030. Then, President Trump's day one executive orders just declared a national energy emergency, fast-tracking nuclear power and U.S. uranium production. Meanwhile, AI data centers are draining the grid. Wind and solar can't scale fast enough, and fossil fuels are off limits. Big tech, Microsoft, Google, Oracle, they're all turning to nuclear. Homeland holds the fuel that they'll need. And remember this, 98% of America's uranium is imported. Russia's banned exports. China's hoarding supply. Homeland controls one of the few domestic assets left, and it's flying completely under the radar. So check out Homeland Uranium, ticker symbol OTC, HLUCF on the OTC, and HLU on the TSXV. Link in description.
Yep. I mean, okay, it's not it's not the $3 or whatever we had whenever, but it's still there. There is no liquidity in London, if the shakeout has discouraged ordinary people from going in and buying ETFs, which is a real problem because, the ETFs basically, if you look at what's stored in the London vaults, it's almost all ETFs. So if you get subscribers going in for silver ETFs, then, the problem is going to come back in spades. So, it's still there. And I don't think what we have seen has really discouraged the retail market, if you like. I mean, everybody I talk to around the world, they're still incredibly busy dealing in coins, small bars, and all the rest of it. The public are still buying this. I think there's a bit more two-way trade, but the Perth Mint has got nothing. It's sold out.
Yep.
And this is a story I'm hearing all over the place. So there is tightness in these markets. Now, I think the hope is that you can just sort of sit on it for a little bit. Then, the enthusiasm will go away. This has happened before when we saw the spike in silver. Was it back I can't remember when it was. It was not all that long ago, a few years back. the enthusiasm went away because they just basically ran up the price and then bashed it, which is roughly what, that's a standard tactic, basically. So how long this consolidation is going to last is difficult to say. But, the clock is ticking on the shorts. That is really the problem. And if you're a trader, then good luck to you. You got your life in your own hands. That's not what we're talking about. If, on the other hand, you're a stacker, then you say, hallelujah, I can buy some stuff a little bit cheaper than I thought I could yesterday. And that's the right attitude to take. Just keep stacking. I mean, we've seen it before. You sort of see price run up and then it comes down and all the rest of it. And everybody says, oh, it was overbought and stuff. So they stop buying and then it runs away. And suddenly they find that what they sold, say at $2,700 or $2,070, which is where it consolidated after COVID, they're out of the market. And here we are close to 4,000. Help, what do I do? I mean, idiots. You've stacked for a reason. You're getting out of credit. That's the whole thing. It's not gold going up. It's the dollar and all the other fiat currencies going down. And we can now see the path to their complete destruction. That is the key thing. This is not a time to accumulate wealth. It's a time basically to secure what you've got. And that means getting the hell out of credit.
Yeah, so here's a chart to exemplify the spot to futures ratio, which is effectively a measure of backwardation. You've got the top chart here, which is the silver spot divided by the silver futures contract. And, the higher this goes, the stronger the backwardation, and the lower it goes, it's vice versa. It works in the other way. And so you look at the chart down below it, that's the nominal silver price. And what you'll notice, anytime we have these big spikes in silver, it corresponds to a big spike down or up on the chart above, indicating backwardation. And you had it here too recently, as of a couple of weeks ago, corresponding to this recent move up in the silver price. So we haven't reached these levels of backwardation since 2013 or so, even 20 or 2009. So, I mean, this thing doesn't even look like it's gotten started. You look at the 1990s. You look at the 80s here. I mean, we had a backwardation of spot overtaking futures by 1.26%.
Yeah,
and that corresponds to that big high in the 1980s.
Yeah, so. Absolutely. There is another aspect of this, which I think is a hidden thing. Earlier this year, we found, much to our amazement, that bullion was being taken out of the Bank of England's vaults and shipped over to COMEX to benefit from the arbitrage, as it were. The arbitrage was the other way. London was below COMEX. COMEX, huge great premium. Why? Because of uncertainty of whether gold will be tariffed or whatever. So, but the thing about it is that certainly commercial entities do not store very much gold in the Bank of England. It is mostly, and when I say mostly, not quite entirely, but because we don't really have the true figures, it is other central banks. Now, what will have gone out is leased gold. Now, put yourself in the shoes of a central bank using the facilities of the Bank of England, which until now you felt quite confident because you lease your gold. Basically, it pays for the storage costs, and also you get a bit of a margin on top, which means that you've got this sterile asset which is actually earning you something, which is great. You have the comfort that the Bank of England is going to continue to store that gold over the life of the lease. All that's happening is that there is a book entry transfer system. The bullion's got to remain in a vault, for goodness sake. So it may as well remain in the Bank of England's vault. So as a foreign central bank, you're sitting there quite comfortably. At the end of the lease period, you haven't lost control over the gold. Mm-hmm. Now, this is very different from the early days when gold was actually taken out of storage and then sold into the market as part of the carry trade, whereby hedge funds and others would go and buy T-bills. I mean, T-bills in those days were yielding as high as 10%, and over the decades fell to something like 5%. And with gold you could lease at 1%. I mean, it was a trade in heaven. It really was. But now, the Bank of England doesn't behave like that. The Bank of England controls it. But the key thing is that if you lease gold, it is actually your property over the duration of the lease. So you can do what you want with it. So the Bank of England couldn't stop it going out. But looking at it from the point of view of the foreign central bank, you've lost control over it. Are you going to get it back?
Mm-hmm.
You don't know. What you are likely to do, however, is to take the view that you're going to exit this leasing game. There's no point. Because if you can't secure your asset, why lease it? Yeah. So on that basis, I think what the London market is finding, and you won't find anyone writing about this or anything. What the London market, I think, is finding is that there is a tightness of supply. I'm sure the bullion banks are completely aware of this. Because if what I'm saying is true, and I believe it is true because it's a reasonable assumption, then the bullion banking, the LBMA community will know that they have got to manage things, if you like, with less liquidity, physical liquidity in the future. So this idea of hypothecating, rehypothecating, that story is coming to an end. And it's interesting that at the LBMA's annual bun fight, which was last week, they did a poll of attendees. They always do this to see what they reckon the gold price is going to be at the end of the next year or by the time of the next annual meeting. And the average came out at just under $5,000. So, these guys know that it's going up. And they're going to keep, they are doing a pretty good job of keeping on an even keel. I think that the bullion banks in London do have a bit of stock. Now, I don't know that they've covered all their liabilities because they also have unallocated accounts, and those unallocated accounts are just generally covered and not necessarily totally covered by gold. So, but they have got that little bit of liquidity and they're not losing it. The problem, if anything, is likely to be on COMEX.
Have you heard anything? Have you heard anything about London leasing their silver from China? Like these 3-month leases?
Yeah, not so much. There was a little bit of a story around that. China and India were supplying silver on the really big backwardation. When we saw backwardation of $2 or $3, whatever.
And the leases supposedly go for 3 months, which takes us to around December or January in terms of when the leases end, and they have to return the silver back to those respective countries. So, if you're looking for a timeline, could we not anticipate sometime this winter we see this massive backwardation kick back up again?
I wouldn't rule it out, but I don't know the terms of the leases, and I don't know that that silver was leased from China and delivered into the London market. I would doubt it personally, because apart from anything else, the People's Bank of China actually controls the silver market as well as the gold market. You can't move without getting permissions from the People's Bank of China. But the amount of silver in the Shanghai Futures Exchange vaults, as far as I can see, has actually been falling. So I think that's been taken out of the vaults. But you see, I would expect this anyway, because industrial corporations, making solar panels and all the rest of it, they keep their stock in these vaults. So they'll be drawing it down anyway. But I think the liquidity is diminishing as a result. So, the whole thing is tightening up, but not necessarily in the way in which you were suggesting.
From a sovereign standpoint, does any sovereign entity, a country, a nation state, something of that nature, Does any sovereign entity benefit from a higher gold and or silver price? Is there the incentive to let the price rise?
I don't think so, because there's always another side to the story. I mean, if you look at a central bank that's been accumulating gold and selling dollars, in most cases, they've probably still got more foreign currencies, more fiat currencies than they have gold.
Mm-hmm.
I think what they're doing is they're trying to protect themselves. This isn't a trade, if you like.
Right.
If you see what I mean. A trade giving them a benefit. So, no, I mean, the whole system it's basically the whole of the fiat currency system is coming to an end, which threatens the very existence of central banks themselves. So I don't see that, they're necessarily happy about this. I mean, there is the geopolitical side of this, of course. China has more or less cornered the physical market. And we now know what China's plans are to protect the yuan. I mean, basically, the SGE is opening vaults in Hong Kong, and also they've already opened in Hong Kong, I understand. They're also opening in Saudi Arabia. And there will be facilities all around the ASEAN nations whereby you can settle trade differences in yuan or gold. And I see today Cambodia has announced, I don't know if this has been verified, has announced that it's prepared to store its gold in Shanghai Gold Exchange vaults. So we can see that as our system here collapses, post-Bretton Woods, post-Bretton Woods is coming to an end. Chinese understand this. This is why they've cornered the gold market. They have protected themselves from our follies, from our destruction, from our debt problems, from the collapse of our currencies. And consequently, they will put their currency on some sort of gold standard. And we can see how this is going to be rather like a sort of Bretton Woods too, but only in trade settlements. I think that's the way it's going to work. But this is something which is as much driven by necessity as geopolitics, if you like. So to answer your question, I can't see there's a clear case of central banks seeking to to profit from this. I suppose that there are some smaller nations, maybe within the Shanghai Cooperation Organization, who are very gold rich in terms of resources. They're probably, some of the officials there may be cheering from the sidelines, but nothing really material as far as we're concerned.
Am I right to presume that what you're kind of alluding to for investors out there is to structure a portfolio, pretty much metals dominant, i.e. physical gold and silver, or do you also have room for equities in that portfolio as well? Like if you were to prepare a portfolio, given everything that we've alluded to so far in this podcast, how would that portfolio look from a very general perspective?
Yeah, well, I mean, obviously, if you're looking at fiat currencies going down, and the other way of expressing this is the way in which everybody's expressing it, you're going to see gold and silver rise. It's also true of base metals. Base metals priced in gold are the cheapest they've ever been. They really are. Now, this is because gold front runs things, admittedly. But it does tell us that next year we're going to see base metals and other commodities, foodstuffs, for example, rise in price very substantially. And I know nobody's expecting this, but this is what's going to happen. So, that I think gives you some clues to how you should structure a portfolio. But as far as I'm concerned, there is another problem there, and that is you don't own anything. When you might sort of have an electronic record that you hold shares in, say, Newmont Mines or something. You don't own it. Basically, what happens is that the management of Newmont Mines has an obligation to deliver to its shareholder an income stream, if you like, in the form of dividends and accumulation within the balance sheet. But who's the shareholder? DTCC or Euroclear. They're the shareholder, and they've got a knock-on obligation to you. So when the whole system falls apart and markets need to have collateral in order to continue to survive, guess what? They'll take what you think are your shares, because they're not your shares. They'll all be pledged. So this is why I say just get the hell out of credit. You don't want to have credit at all.
Even if you have a stock certificate, then that's not going to...
Well, if you've got a stock certificate, yeah, if you've got a stock certificate, then that's different. But the vast majority of people don't have a stock certificate. But even then, it's still credit, because all you have, if you like, is a piece of paper that says that the company is obligated to provide me with an income stream, which pro rata out of all the shares there are, I've got 0.0001% of this company, and that's what I'm entitled to. They've got to pay me that. They are obliged to pay me that. But it's still credit.
Wow. Well, definitely an eye-opening interview, Alasdair. Anything else you want to talk about that we didn't get into before we sign off here?
I don't think so. I think we keep this message as simple as possible. Just be aware of what the hell is going on with the value of fiat currencies. And we are in the end game for them. And I just cannot see how governments, how their advisors can get us out of this one. Because it's the blind leading the blind at the moment. It really is. And even then, they've been lying so much over the last 54 years about what they have and what they haven't got in the form of real money, which is legal money in common law. Everybody's common law, gold. We don't know what they've got. We really don't. They've got to establish that. So the whole thing is, I think, just too dangerous to make any further comment. No, leave it at that. Now, obviously, I mean, you run a very, very good Substack. I run a Substack as well, and I'm in the business of trying to educate people, which is why I enjoy being on this with you, Danny. We're trying to, get people to wake up to what the hell is going on and to protect themselves and stop fooling around with Bitcoin or, the Magnificent Seven or whatever. I mean, you're going to miss the top if you get out right now. You might not have missed the top. I don't know, but it's just dangerous. It's just dangerous.
Yeah, you're playing with fire for sure. Alasdair, You alluded to your Substack. What is your Substack where people can find you?
MacleodFinance.com. Google it, take it straight there.
All right. I'll do you one even better. It'll be in the description box down below, so be sure to check it out, guys. Alasdair, thank you so much for coming on, my friend. Always a pleasure, but an eye-opener nonetheless, hearing from you. So,
well, thank you very much. Thank you very much for helping me spread the word.
100%, my friend. And guys, if you enjoyed this podcast, consider liking the video and commenting. Go, Alasdair, go. If you agreed with Alasdair's analysis, if you disagree with anything, that's okay too. But let me know what you disagreed on and why. Drop me your reasoning. And if you agreed on everything, also let me know. I do, in fact, read all the comments, good or bad. So let me know your thoughts. And by liking, subscribing, commenting, doing all the YouTube stuff, you help in pushing this message, this video, and this channel up in the algorithm. So it may not seem like much, but a little bit does go a long way. And any bit of help is helpful by definition, right? Anyways, I'll catch you guys later. Watch me on Substack as well for all of my videos early, ad-free, and uncensored. It's capitalcosm.substack.com, and I will see you next time. Bye.